What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my stock market monthly update series for the month of October 2023. Now, I'm a little late to upload this month, so I apologize for that, but essentially what we do in these videos is we just give a really quick update on the current state of the stock market and the economy by splitting it up into three parts. Now, in part one, we take a look at the current performance of the stock market and how things are going so far. In part two, we cover any broader economic and stock market news and updates, anything that's affecting the stock market, which recently has mostly involved inflation, interest rates, and even some political drama in Congress as well. So we'll talk about a few of those things. And then we finish up with part three, where we just do a really quick kind of rapid fire of the biggest gainers and losers of individual stocks from the past month, and I'll let you know if anything catches my eye there as well. So it's just a fun update I do every month on the stock market. I hope you guys are enjoying it. I love doing these for you guys. But let's not waste any more time. Let's go ahead and jump into it, starting with part one. All right, so taking a look here at the stock market's performance, September was actually a pretty nice dip here that I think we desperately needed because the market has really been on fire this year. However, September was actually the second worst performing month of the year for the S&P 500 at close to a 5% drop. The only other month that saw a bigger dip was January. As a whole, though, this now leaves the S&P up about 45% in the past 5 years, up over 10% year to date, and only down around 12% from an all-time high. While the tech-heavy Nasdaq, on the other hand, continues to see more drastic swings, up over 62% in the past 5 years, up over 25% year to date, but yet it is still down close to 20% from the top. So basically the dip that we saw this past month is really helping send the Nasdaq back into correction territory. And I gotta say, guys, I am loving it. Now, sure, the broader market is still up a lot, but that's why I'm hoping that this downtrend continues, because I want to be able to buy my favorite stocks, invest in them long term at the best, lowest possible prices. So more volatility, more dips in the market, I am all for that. Well, it looks like more volatility is exactly what we'll be getting in the coming year, as this now brings us over to part two of the video, where we cover any broader news and updates. Now, the current dip we're going through has obviously had almost everything to do with lingering inflation. However, the recent threat of a government shutdown definitely helped send stocks lower this past month as well. Now, I already covered the shutdown in one of my recent shorter format videos, where I gave my opinion that the whole thing is being a bit overblown, which really turned out to be true, as a resolution was indeed passed right before the deadline, preventing an actual government shutdown. However, that also led to the recall of House Speaker McCarthy, so a bit of a civil war is kind of going on here within the Republican Party. However, I fully expect a replacement to be voted for next week, and it'll ultimately mean very little for the stock market, at least in my opinion. What I do think will impact the stock market much more heavily, though, in the coming months is our lingering inflation and high interest rates, because after seeing our inflation rates plummet throughout the past year, there was a sudden and surprising uptick these past 2 months, which increased to 3.7% in August. That's close to double the Fed's target rate of 2%. And that's pretty demoralizing considering how hard we've been fighting inflation with really high interest rates that are starting to wreak havoc on the economy and, of course, the stock market. Not only was this one of the sharpest inclines to interest rates in history, but we're also sitting higher right now than even right before the Great Recession. And it's not just the stock market that it's affecting, but also the housing market, which is now at the highest mortgage rates in decades, with the popular 30-year fixed rate quickly closing in on a whopping 8%, which caused new home sales to plummet by 9% last month. That's really not a good sign, considering that the Fed is reportedly willing to keep rates higher now for longer than previously expected, as long as inflation remains elevated. Here are some comments, for example, from Fed Governor Michelle Bowman this week. who stated, "I remain willing to support raising the federal funds rate at a future meeting if the incoming data indicates that progress on inflation has stalled or is too slow to bring inflation down to 2% in a timely manner." Well, that certainly looks to be the case if the last 2 months are anything to go by. I mean, we're definitely stalling. We're definitely not bringing inflation down as much as we should be. And to which the chief investment officer from Independent Advisor Alliance noted that some seasonal weakness in September and October is pretty normal and somewhat expected. It tends to be a seasonal kind of downturn for stocks. But the more unique case here of higher interest rates and that lingering on, well, it could definitely mean that there is more downside ahead for the stock market. And that's a sentiment that I strongly agree with myself. I think the longer that all of this continues, the more there is a chance of a recession, the more volatility that will be headed towards the stock market. And again, that's not something that I'm necessarily afraid of. That's something I'm kind of welcoming because I do think that the stock market has climbed a bit too much. Now, there are still some great deals to be had out there in the market. I'm still buying a lot of stocks that I think are cheap and trading on sale, but I've even had to trim some of my larger, more highly valued, expensive stocks in my portfolio that were taking up too much space in it. Like, for example, earlier this year, I trimmed just a little bit off the top of some of my Nvidia position, some of my Microsoft position, still two of my biggest holdings in my portfolio, but they were becoming so large. They were taking up a big chunk of my portfolio, and at the current valuations, they were a bit expensive. I thought it'd be best to take some of those profits, just a little bit off the top, and put that towards bolstering up my cash position and also buying up some other stocks that I think are trading cheaper on discounts right now. I think that's a pretty fair strategy for the current environment. Anything that's in your portfolio taking up too much space, it's really expensive, highly valued, you don't see a lot of upside in the kind of medium term, I think it's okay to take some of those profits, rebalance the portfolio a little bit, still looking for great value stocks out there. Anything that you see that you think is cheap, pick that up, but at the same time putting more money into the cash position in case we do go into a recession, in case the market does fall more, we want to be able to take advantage of those opportunities too. So it's just a bit of a balancing act, but nothing too crazy, nothing to get too fearful about. Just have to be smart about it. But anyway, let me know if you guys feel the same way that I do. Are you doing similar things? I'd love to hear your thoughts down in the comment section. But with that said, we got to finish up the video here. Let's go ahead and finish up now with part 3. We're going to just do a quick rapid fire of the biggest gainers and losers of the past month. And I'll let you know if any of these stocks catch my eye as well. All right, well, starting first here with the biggest gainers. Really not much to see this month, as it was, again, mostly a down month, with only 9 large cap stocks, even rising by double-digit percentage, and I don't particularly like any of them anyway. I mean, the biggest gainer was Splunk, which is a decent cloud computing company, but they're not profitable yet, and they have already nearly doubled in a stock price over the past year, so it's not too exciting for me personally. And then outside of that, everything else just had a single-digit climb. The most notable ones were probably Mobileye, which was spun off from Intel. They rose about 9%. There was United Health, which is a pretty popular health insurance company, rose about 7%. And Duolingo, which is a stock that I do own myself. It's mostly a language learning app, and it rose about 6%. But besides that, there really wasn't anything too exciting on the gainers list. Turning over to the biggest losers, though, we did see a ton of stocks lose more than a fifth of their value. However, most of them were some of the less popular stocks in the market. I mean, Aramark, for example, was the worst performer at a 36% drop. That's a food and uniform services company. It's actually also one of the largest holdings of George Soros, but I've never been a fan of it. The company is a little too boring for me, just not too excited about it. We also had the FinTech Square, or now they're known as Block. They fell about 28%. But I prefer PayPal much more at the current valuation, which I actually just included in my 3 stocks on sale series for October. If you want to learn more about that, you can watch that video if you'd like. But we also had Chewy fall 27%, which I actually used to be interested in that one since they're an online pet products retailer. I just feel like people are always going to spend more money on pets, sometimes even more than they spend on themselves. So it seemed like a good business to me. But over time, I just realized that most people are either going to buy their supplies at regular pet retail stores like PetSmart or Petco, which also have in-person services like grooming and other things to help bring customers into their stores, or they're going to shop at big box retailers like Target and Walmart, where you're already shopping for human stuff anyway, so you might as well do your pet shopping at the same time. And all of these, by the way, have growing e-commerce platforms too. And even then, there's still the giant elephant in the room of Amazon, which is really where the vast majority of people shop online these days. So I just don't see how Chewy can compete with all of that. And it's probably why they've struggled so much with profitability despite having pretty high revenue growth. I just think that they have to spend too much on advertising to attract customers, and that really weighs on their margins. And in this current economy, I just think Wall Street is not going to be a big fan of that, and that's probably why the stock has really crumbled in recent years, losing almost half its value in the past 5. So even if they do still have some potential, I just feel like I'd rather invest my money elsewhere on other more attractive e-commerce stocks out there as opposed to gambling on this one. Speaking of other e-commerce platforms though, Shopify also fell over 20% last month, and I think it's getting pretty attractive here, down over 70% from the pandemic highs. They've got a very strong business providing online shopping infrastructure to other businesses. I think it's a very highly needed service, especially for the future. And while the current valuation is still very expensive at a forward PE above 70 and a PS above 10, the more forward-looking PEG ratio is only less than 1. And that's pretty attractive for an e-commerce leader that is still growing sales by around 20% a year. Now, profits did take a hit last year coming off the pandemic, and they're still struggling a bit right now. But I do think that they'll easily turn that around longer term. So this could very well be a buying opportunity here. I think I'll wait a little longer myself, but if it continues to fall like this, I'll probably start buying a small amount myself soon. I think the stock does have a lot of long-term potential. Okay, we're running low on time, so I'm just going to speed through a few more pages of this, scrolling down some more popular stocks that fell. I would say probably Align Technologies. They sell braces for your teeth online. There's NIO, which is the Chinese electric vehicle company. NextEra Energy, which is a very solid renewable energy company with a growing dividend. Unity Software, one of the biggest gaming engines in the world. And Illumina, a more speculative kind of biotech that Cathie Woods has been investing in for years. All of those fell over 20% each. I would say probably my favorite is NIO. I do own a small amount myself, recently purchased it in the past year. But I just like their cars, I like their technologies, I really like their aggressive expansion internationally. So with the stock down almost 90% from the top, I think it's looking pretty attractive here as a high risk but also high reward kind of speculative stock. Scrolling down further though, a bunch of real estate and travel type of stocks are down big, mostly because of the economy and the housing market that are both struggling. But we had the online real estate company Zillow, the casino giants MGM and Caesars, and the cruise line Carnival all falling close to 20% each. We also had the discount retailer Dollar General fall about the same amount, which is starting to look a little attractive here as it's now trading even lower than before the pandemic. And I might have to do a research video on it soon because a lot of people have been asking me for one. Personally, I prefer investing in Amazon over most brick and mortar retailers though, but given the weak economy and lingering inflation, you would think Dollar General should see maybe an uptick in foot traffic because of their low cost items. And with the stock trading significantly cheaper than the sector on a PE ratio basis, it might be worth taking a closer look. We'll have to see. I'm going to keep that one on my radar for sure. Scrolling down further though, another big casino stock, Las Vegas Sands, fell over 18%, and some more travel stocks, United Airlines, Delta Airlines, and Trip.com, all falling about the same amount too. Social media company Snapchat fell another 18%. I think Meta is much better stock. I don't know why you'd invest in Snapchat when you could just have Meta. But also Match Group fell another 17%, which is the parent company to a bunch of dating apps like Tinder and Hinge. Could be some long-term potential with that one. I do think online dating is going to rise heavily in the future. But my favorite pickup of all of these is actually on the next page with the fintech SoFi, who fell 17% this past month. There was also the popular energy drink maker Celsius, Post-it and Scotch tape maker 3M, and a couple of e-commerce platforms in Etsy and JD.com, all falling around 17% as well. But like I said, SoFi would be my favorite here. The stock is still up over 60% in the past year. So just a small pullback really that we're seeing here. but I think the strong performance is well deserved given the explosive growth that they've been having. I know they're technically not GAAP profitable yet, but I believe that's coming soon, and in the meantime, sales are still growing by around 30% a year, and with student loan repayments starting back up this month, I think a lot of people will be looking to refinance on SoFi as well. So it's just another thing to look forward to in what is already a very well diversified fintech platform for all things finance related. And I really just happen to like this one a lot long term. I have high hopes for it. But I think I'll go ahead and stop right there. We're running a little low on time. I try to get these videos down to around 15 minutes or so. We usually go quite a bit over that, but I like to keep it a little smaller so that I don't bombard you with too much information. I know these videos can get kind of jam-packed a bit, but I hope that you're enjoying the series either way. I hope you enjoyed this month's update. Leave your thoughts and comments down below for me. I'd love to read those and respond. And I hope you're all doing well, my friends, and I will catch you in the next video. Thanks again for all your support. It means so much to me. I'll see you next time. Bye-bye.